All right. Hey, everybody. Thanks for coming out. If you need testosterone, downstairs, Low T Nation, John Grayson is a regular member there. He's here every Thursday, so talk to him. But thanks to John for finding this spot that we can meet in. Thanks to you all for finding the spot after John found it. I know some people had some difficulty. I was telling somebody earlier, we loved doing them at Third Door. We will not be doing them at Third Door anymore. So if anybody has ideas of good locations, feel free to let us know. But this seems to be working out. We've got Harrison back there bartending. He's he's doing his best. He's trying. We kept it simple this time, just beer and wine. But Harrison actually works for us. He's not just a bartender. In fact, I didn't know he was a bartender at all, but he's here. Today we're going to be talking about the idea of a soft landing. And you can see here kind of this iconic image from US Airways Flight 1549 that landed in the Hudson in January of 2009. Captain Charles Sullenberger, old Sully, landed that. It probably did not feel soft at the time, but you look back at it and say, wow, that was pretty impressive, pretty smooth, given the fact that two engines were out. So we're going to be talking a lot about what a soft landing could look like. If you're reading the Wall Street Journal or watching CNBC or any of those talking head shows, you've probably heard people talk about, hey, the economy's not great, but could we have a soft landing? What does that mean? How do we get there? What's the impact? That's certainly going to be a theme of the type of questions that we're going to try to answer through this presentation. As always, we do have a disclosure here. You guys can read that. We've got a lot of attorneys present, so if you have questions, feel free to consult with them. But the most important thing, I think, is really the Q&A and the polling. So if you have a phone, go ahead and scan that QR code. It will load up a website that has places where you can ask questions. John will kind of lead us through those questions at the end. There's also going to be several places where you can actually answer polling questions. And we're going to, I think, start right away with a poll. So in your daily life, is inflation moderating or accelerating? We'll give you guys a little bit of time to answer that. We'll see if it shows up on the screen. I don't know if it will or not. Oh, yeah, look at that. Woo! Man, we got a dead heat. We've got a dead heat. Oh, moderating. Man.
People just fall on the ground.
Yeah. A lot of groupthink going on right now. So most people here are saying slight advantage to moderating as opposed to accelerating. We would probably tend to agree just with our own internal poll. There's certainly pockets of the economy where there's been challenges, and we're going to talk about those as it relates to inflation. But man, moderating, just running away with this thing now. With that, we'll turn it over to Ben, and very cool to see how many people know how to use the technology that we set up. So great job by everybody.
Thanks, Andrew. So as Andrew pointed out, the real question that we're trying to answer right now is whether or not we're going to have this soft landing. And what does that look like? We've laid out kind of what that might look like at previous presentations, but then we'll go into it a little bit more detail today. Buzz Aldrin, second man on the moon, first man, according to him, to pee his pants on the moon, said that there's a historical milestone in the fact that our Apollo 11 landing on the moon took place a mere 66 years after the Wright brothers' flight. I think that's just a really interesting testament to the ingenuity of the American people. 66 years after the Wright brothers' 30-mile-an-hour flight, we were landing on the moon, and by the way, taking off from the same location 50 years before Elon Musk revolutionized the world by doing that on Earth. So, I think that's something to remember and consider as we look at where we're going as a society and as an economy, and that progress can take place, especially if we look at it in decades terms. But right now, we're looking at it in near-term terms because that's what we're dealing with. Right now, the investment landscape is pretty much, we've used this chart in previous presentations, and essentially it shows the flow chart of how high inflation begets interest rates, begets the Fed tightening monetary policy. And we laid out upside and downside risks in previous presentations. Those are still intact today, but there's some more optimism. For one, in terms of the upside risk, inflation is beginning to turn down. And we'll talk a little bit about that in the next few slides. But especially on the downside risk, we're seeing some real positives. First of all, Europe is benefiting from a much stiffer resistance from the Ukrainians, as well as a much milder winter in Europe, meaning that they don't have to really draw down a lot of those natural gas supplies. Central banks are beginning to raise rates at a slower pace. Just a few months ago, they were raising rates by 75 basis points each meeting. Now, it looks like in February, we might raise by just 25 basis points. So that's a positive. And then we're seeing in China right now, they're shifting away from COVID zero. So that reduces the likelihood of more supply-demand supply issues going forward. So these are all good pieces of news that reduce some of that downside risk that we've been facing. At the same time, you don't really want to change your investment strategy full course. You still need to be smart about your personal investments. You still need to be smart about investing in equities that actually pay you cash, that deliver good value, especially in a high interest rate environment where the cost of just keeping something in cash is high. And one area where we've seen significant opportunity increase is on the fixed income side. Just a year or two ago, you were investing in just getting 50 basis points on a 10-year bond. Now you can get 3.5%. So we're going to look at all this in a little bit more detail going forward. We're going to talk about inflation, the economy, markets, and then we have some ideas. Tom, Jason, and I attended a conference in Orlando last week, and we heard from dozens of retail companies who were talking about their plans for their business and what they're seeing in the macro economy. So we'll talk a little bit about that. But the picture on the right is a picture of a helicopter doing what is called auto rotation. This is when, if you're flying a plane, if you're landing a plane like Sullenberger, you glide, and everyone kind of gets that. The wings support the plane as it descends through the air. But what happens if you lose power in a helicopter? Well, there's this thing called auto rotation where you essentially tip the helicopter and allow the rotors to spin like a pinwheel. And so as the helicopter falls, you're spinning the rotors and maintaining lift. And that's essentially what we're trying to do right now. The Fed is trying to hurt the economy such that we bring inflation down, but not to the extent that it drops like a rock out of the sky. So this was in a book that I read actually just a couple months ago, and I thought it was a pretty good analogy. Jumping into it, core inflation is declining. That's the green line there. We had a kind of second peak in the fall, but we are beginning to trend down. Headline inflation peaked at the same time gas prices peaked in the summertime. So this is good news. And if you look at the month-over-month trajectory of inflation, this is even more good news. We're actually at 0.26% inflation in the month of December on a month-over-month basis. That translates to 3.2% annualized. So if you extrapolate that out and say we just level off on this month-over-month inflation over the course of the next 12 months, we're looking at about a 3% inflation economy, at least on the core basis. Right now, headline inflation is even lower than that, but that's because energy prices are coming down, et cetera. Goods prices are probably the biggest declining piece of prices right now. Right now, in fact, goods prices are in deflationary mode. This chart shows the ISM Manufacturing Survey and the ISM Services Survey. And any number above 50 indicates the prices are rising. Numbers below 50 indicate the prices are falling, and we're at 39.4 right now on the manufacturing side. Services inflation is coming down a little bit, but it's not coming down nearly as fast as manufacturing prices. A lot of that is cost inputs as commodity costs have fallen. From the conference that we attended last week, we're beginning to see a lot of retailers actually push back on prices. They're no longer using prices as the lever to get a lot of growth. they're saying the writing's a little bit on the wall. We don't want to push prices too much because we're going to turn off our consumer. Dutch Bros, which is that new coffee shop that started out in Oregon, the CEO was up on the stage and said, we really don't want to raise prices any more than we already have. Chewy's, the CEO and CFO were both up on the stand. The CFO was saying, we're going to have one more price increase, and then we hope not to have any more. And then the CEO kind of corrected him and said, we're not going to have any more price increases, because they understand that the consumer is stretched right now, and prices is not the way to get that incremental sale. So I thought that was interesting, as you look at what companies are actually planning to do. This is very different from what we were seeing 6 months ago, when companies were talking about pricing power. Oreo prices were going up 10-12% every 3 months. We're not seeing that nearly as much anymore. We are seeing inflation in wages, though. And this is one area where the Federal Reserve is concerned. Not because they don't want people making more money, but because they don't want people making more money for doing the same amount of work. They would love to reward productivity and get wages up that way. But the fact of the matter is, I don't think that the average American is 6% more productive than they were last year. So they want that wage growth to taper off to about 3.5% to 4%. That they say that would be in the sweet spot. The Fed chairman, Jay Powell, has actually talked about this and said that 2016 to 2020 was a great sweet spot for the American economy. Wage growth was 3 to 4%, 3 to 4.5%. Inflation was about 2%. GDP growth was robust. He says that we want to get right back to that. And part of that is getting wage growth back to that 3 to 4% range. The problem with this is that there are still a lot of job openings in the economy. There are 1.7 open jobs for every unemployed person in the United States, which basically means every unemployed person could get hired 2 times over right now. And you can see the correlation here. The orange line is that ratio, job openings for every unemployed person, and the green line is wage growth. And they've tracked each other remarkably consistently over the last couple of years because the market is so tight. So what the Fed wants to do is loosen that jobs picture just a little bit so that we can get wages to normalize a little bit more to that 3 to 4% range. One thing that is interesting, and the New York Fed did this survey, and it might be a little bit difficult to see. The point here is that on the left-hand side, this is employees' satisfaction with their current wage. And if you're thinking it's a straight line right across, that's because it is. Employees are no less satisfied with their wage than they have been for the last 7 years. But they now think that employers are going to match their counteroffers. So if an employee gets a counteroffer, there's an increasingly likelihood in the employee's mind that the employer is going to match that. And so they're a little bit emboldened right now, which isn't saying that's not necessarily a bad thing, but it's something to consider as we look at wage growth going forward. A positive of the wage situation, though, is that average hourly earnings are beginning to stabilize a little bit. This was the most concerning chart for me that we posted up in July. And it's probably the one that gives me the most optimism going forward. In July, we were going off a cliff in terms of real average hourly earnings. So this is how much do people get paid on an hourly basis minus inflation. And that was negative, and it was becoming more and more negative every month. That's beginning to move upward because inflation's coming down. And that's good news, because if you are getting higher real average hourly earnings, then that's additional money that you can use to grow GDP. It's additional money that you can use to bolster savings. It's additional money that you can use to pay down credit. All 3 things are good for the economy. And it's necessary because we are continuing to draw down those excess savings that we had during the pandemic. So during COVID, because Americans weren't going out and spending money, and because of the stimulus checks, we accumulated about $2.5 trillion of what they call excess savings. This is savings in excess of what Americans had in their bank accounts before COVID. we've gradually worked that down, and we now stand at about $1 trillion. And that's going down by $100 billion every month. The way to slow that down is to increase that real average hourly earnings, lower inflation, and increase that savings rate. The savings rates right now are very bad. In fact, some might argue they're negative when you consider additional credit usage. So to some extent, it does seem like the American consumer is living on a bit of borrowed time. We have 10 months to allow inflation to kind of continue to come down and flatten that line. And if we can maintain, if we can lower that inflation rate, and we can smooth out this curve on the left-hand side, then we can maintain some of those excess savings that we got in the pandemic, and you're not seeing this dramatic fall off in terms of individuals' balance sheet. Credit quality is normalizing, which means that delinquencies are going up, but that is the green line. So even though balances are going up, you're still seeing credit card delinquencies relatively low, especially when you compare it to the global financial crisis. So that's good news. You don't want to see a big uptick in this. And again, with all the excess savings, you're not seeing that right now, but this could become more of an issue at the end of the year if we can't increase that savings rate for consumers. So the question, are there enough auto rotations left? Well, inflation is falling, but it will need to continue to fall because we need to increase that average real hourly earnings for the average American. That will allow savings to grow, it'll allow credit balances to normalize a little bit, and the employment situation will need to remain robust. So Andrew's going to talk a little bit more about the employment situation, but inflation does seem to be coming.
Yeah, and quick programming note, if you need a drink or food or anything, raise your hand. If you have a question, use the app thing. Raise your hand if you need another drink. Asa or somebody will hook it up. And if you're on the Zoom call, especially my man Jerry, raise your hand and let me know how quickly Tracy brings you a drink. See how that goes. So Ben talked a lot about normalization, and normalization can be a bit of a scary thing because when you've been in a period of non-normal, abnormal behavior, you can look at really rapid increases to a period of normal. You can look at really rapid declines to a period of normal. If you have kids, you know normalization is really weird. You know, what is normal? Nobody even really knows. But we're looking at the job market on these slides, and we are starting to see behavior that I think is a positive sign for normalization. On one hand, we are seeing a decline in the businesses that are wanting to hire more people or how much they are wanting to hire. On the left-hand side, you can see small businesses. On the right-hand side, this is small, but it will be on the website if you want to see it probably tomorrow. You can see larger companies' hiring intentions. And we're seeing a decline. Companies are saying, we don't need to hire or don't plan to hire as many people as maybe we thought we were going to. But we're moving into a more normalized cycle, and we're still seeing modest positivity here. You can see Atlanta on the left, the United States on the right. The pace of hiring has been below the levels from last year, what we were seeing, but we're still hovering at essentially normal levels. We're still seeing some normalcy. As wild as it seems, especially when you think about the United States graph, this time last year, we were still coming out of a period of COVID where there were still entire regions that were really trying to rework their workforce and reacquire talent. There were huge cross sections of the economy, and you still see today, if you go to a restaurant, wait times are probably longer than you expected. There may be sections that are totally empty, even here in Metro Atlanta, because they're still having a hard time filling those positions. But we're seeing some of that normalization start to happen. We do not have companies saying we're going to hire a ton of people, but we do have people saying, you know what, we need some more help. We need some labor in here. The place where you're seeing this normalization probably most prominently is actually in the measure of job postings. Right now, there are about 1.7 job openings for every person that says they want a job, which is a wild state of society, I guess, because if you want a job, you can go get 1.7 on average right now. But we want to see that normalize. In June and July, the concern was that the Fed was going to push the economy into such a negative direction that there were going to be mass layoffs. And that was the path forward. If you think back to our second quarter macro of last year, it was pretty dark. We were talking Ben off the ledge repeatedly just as he was making this presentation. Then he showed it to us and he had to talk us off the ledge. But things were really, really dark. It was a very grim picture as it related to employment. You had some companies really jump in and lay off a lot of people. Right now, though, we talk about that auto rotation of the helicopter. Right now, we're trying to see, can we get enough auto rotations to where rather than laying off tons of people, we actually create a scenario in which we just slow the hiring a little bit and some of the job openings level off. You can see here the pink line is new job postings on Indeed. The blue line is total job postings. And you've got a lot of noise on the new job postings as this is presented on really high frequency basis. But you can see this trend here of the total active postings starting to level off. And we would argue that that's a good thing. That's a more normal thing. We're getting closer to a more normal labor market. We had lots of layoffs early on. We used several examples last June. Tom talked about his brother. He worked for a company where they had this huge meeting and everybody thought, hey, we're about to IPO. It's a tech startup. This is going to be awesome. We're all going to be rich. We have these company stock options that we didn't know what they were worth, but now they're going to be worth a ton because we're going to be publicly traded. And it was like, no, actually, we're laying off a huge chunk of you guys. That's where the market was 6 and 9 months ago. We've seen this really level off. And even if you look at a company like Amazon, they made headlines for laying off 18,000 people recently. But if you look back at Q1 and Q2 of last year, they laid off almost 100,000 people. We're not celebrating the fact that 18,000 people were laid off, but if you looked at the midpoint of last year and said, well, they've already laid off 100,000, we would have expected a lot more. And so we're seeing some stickiness in terms of the labor force, and we're also seeing good agility. Some of those high earners, some of those real technically trained and technically educated and gifted workers are finding work pretty quickly. You kind of have this vision of your mind of, this startup lays off a bunch of people that were making $300,000 a year to write code and do something that nobody even really knew what they were doing. They get laid off. Man, they're never getting another job. No, most of those people are finding work much quicker than expected. And that's been pretty widely reported by the Wall Street Journal and others. So the labor market, we feel, is normalizing, and it's normalizing at a level, one, that's happening quicker than we would have expected, and two, happening with a little bit less pain than we would have expected.
So, in making predictions, it's always, it's never easy. And that's why we're not going to do it right now. But I will say, this is what the Federal Reserve thinks is going to happen, which probably means that's not going to come true. And I'll have a slide. Actually, the next slide will show that. But essentially what the Federal Reserve thinks right now is that we're going to go into a period of slower growth, just 0.5% of growth next year. Or this year, I guess, a little bit higher unemployment rate to rise about 1%, and lower inflation. And I think that inflation is going to continue to taper off. In connection with that, I want to draw your attention to 2024 and 2025, where they actually see their own federal funds rate, what they control, they expect that to decline by 100 basis points in 2024 and 100 basis points in 2025. This is the Federal Reserve expectations that they published back in December. So it's interesting, but I would caution drawing too many conclusions from it. This is what they thought was going to happen at each period for 2022. So you can see the revisions. Coming into the year last year, they thought GDP was going to rise by 4%. Well, it's going to grow by about 1.9%. So that wasn't too bad. But if you look at the inflation data, they thought it was going to be 2.6% coming into the year. It's going to be 6.3%. And what they can control, the federal funds rate, they thought was going to be just 0.9% exiting the year. Right now, it's 4.3%. So they were off by a factor of 4 in terms of what they're guiding the market. Now, we've talked about it before. The market does not like surprises. And so when you change the cost of money by a factor of 4, and you haven't conditioned the market for that, the market's not going to react too fondly, especially when this determines to a large extent the prices of stocks and bonds. So this is what happened. For those of you in the back, this is 2020, this is 2021, and this is 2022. And you can see we've raised rates. The Fed has raised the real rate, which is interest rates minus inflation, by almost 200 basis points in the space of a year and a half. This is a huge move to actually change the real cost of money by that amount. We've gone from a loose monetary regime to a very tight monetary regime in not that much time. And the reason this is significant is that the real interest rate really determines, to a large extent, equity market valuations. This is a chart of the earnings yield in the S&P 500 minus the real bond yield. So you go back 10 years here, it's been about constant. The valuation of stocks, essentially, minus the real bond yield. How does this change? How does this adjust actual stock market valuations? When you change the real bond yield. Real bond yields go up, earnings yields go up, stock market valuations go down. And this is what the Fed did. And this is the mechanism by which you can get valuation declines in the stock market with aggressive rate hikes from the Fed. And you can see that in this chart, we inverted the S&P 500 return. That's the green line. And then we used that same real bond yield. That's the orange line. And you can see it's been a 0.91 correlation in 2022, which essentially means that when the Fed raises the real bond yield, you're pretty much going in lockstep with equity market declines because there's negative 0.91 correlation. Interestingly, this is most significant in periods of positive real bond yields. When real yields are negative, stock market doesn't really care. The correlation drops to essentially zero. But when real yields are tight, this is when the Fed really has some control over stock market valuations. And that had a significant impact on returns in 2022. When you're getting 4.5% on treasuries, investing in 1.2% dividend yielding stocks is not as attractive. Investing in 30-year bonds where you're waiting 30 years to get collected money is not as attractive. And this is why 30-year treasuries fell 33% last year. This is why the S&P 500 fell 18%. Interestingly, corresponding to that, we're in a much better interest rate environment now for investing. So that's good. That's the good news. But we have another poll right now. And it says S&P 500 earnings in 2022, A, fell 10% or more, B, were roughly flat, or C, rose 10% plus. So let's see what we get here. Oh, I'm gonna move forward on that because no one's gonna be wrong now. Earnings actually grew in 2022. They were up 13% on a year-over-year basis, and yet the stock market declined 19%. And this is because if you take that spread, the 13% increase in earnings and the 19% decrease in stocks, that's the valuation that is impacted by what the Fed has done. And it's very similar to 2018. The valuation decline there doesn't do it justice. Says stocks were down 6% for the year. They were down 13.5% in the fourth quarter alone. Earnings grew in 2018, stock market fell. Revenue grew in 2018, stock market fell. And that's the same thing that we saw in 2022. This again was in a period of a relatively aggressive Federal Reserve. In 2018, for example, the Fed raised rates so aggressively, and it doesn't seem like that now, considering what we did in 2022, but they raised rates in December and then had to reverse that 6 months later, which is they over-tightened the economy. And so we saw a similar impact on 2022. Going into 2023, sell-side strategists, so when the Morgan Stanley equity strategist gets on CNBC, this is who it's polling. Sell-side strategists are quite negative. This is some Bank of America data, and they say that when sell-side strategists are this negative, subsequent 12-month returns of the S&P 500 are positive 95% of the time. So that's good news. It's, there's 5% where it's not positive. But it is good news in terms of the setup as we go into 2023. Valuations have corrected. Sentiment is relatively negative on Wall Street. And that's probably, it's certainly better than the market environment going into 2022. So monetary stability, to the extent that we get it in 2023, could lead to some equity stability. How could monetary policy be more stable? Well, inflation can come down a bit. This would also probably help the margin outlook for a lot of companies that didn't really know what to do with their cost inflation. Currency volatility would moderate a bit. And the question really stems around demand. Can we keep that employment picture normalizing, but not falling off a cliff? So that's where we stand on equities. Tom's going to talk a little bit about fixed income.
Thanks, Ben. So the tone of fixed income this year is actually going to shift quite a bit from last year. Really, last year it was about really trying to seek shelter in a Fed hike cycle. And as we kind of open 2023, our expectation is the hike cycle is going to slow significantly. As a base case, we're really looking for 2, maybe 3 more Fed hikes this year. And at that point, there's either going to be a pause, or if the economy does take a turn and the auto rotation does not work, we'll probably see some cuts. But what does that mean? You know, as we reach the end of the hike cycle, we start to get into the end of the credit cycle. So what we're starting to see now is that the lowest levels of credit quality are starting to see some cracks. And the reason for that is a number of different aspects of the loan space. So loans are a subset of bonds, usually companies that are either too small to access normal capital markets, or they are not creditworthy enough to do so. And what happens is these are floating rate bonds. Typically, they're often very short term. And what we've seen is as interest rates rise, the interest expense goes up significantly. So when these deals were done 2 years ago, you know, when the banks are looking at these loans, they're saying, hey, you know, if you guys can cover, 1.25 of interest rate expense, we can give you this loan. But what happens is, you start to see, say 1 month LIBOR plus 5%, that's your note. Suddenly LIBOR, 1 month LIBOR is at 4.5%. So that goes from being a bond that costs you 5% a year to 9% a year. And a lot of these companies are not in a position to do that. And so in terms of the canary in the coal mine with credit risk, we think that there is an impending basically pitfall coming in the loan space that could potentially cause some problems in credit. And that's something we're definitely keeping an eye on. So the areas that we think are most vulnerable in the short term are going to be telecom, technology, and in healthcare, specifically within healthcare, senior living. So technology is obviously a place where with rising interest rates, you see a lot of slowing demand, especially from the end user. Telecom is traditionally the most heavily indebted section of the economy. These big companies like Verizon, AT&T, I mean, they're the top 5 most indebted companies in the world, but they get paid every single month. They use that to build out infrastructure. And when this hike cycle comes, some of these smaller companies in the telecom space are really going to get a crunch. And then, of course, senior living has not yet recovered from COVID. And so these are the 3 areas we really see as being potential for the first and earliest blowups in the loan space. So we really want to make sure that clean bonds are where we're at. So in a credit cycle, you really want to be in the cleanest bonds. And the reason for that is as you start to see defaults, you start to see companies fail and stop to pay their debt, you see credit spreads expand. So the worst credit's going to go from being 5 or 6% to 8 or 10 or 12%. And we're not quite there yet. But what we have seen is we've seen tremendous selling as a result of the Fed raising interest rates on very, very, very clean paper. And most of that right now for us is going to be treasury bonds. So right now you can see here at the height of the pandemic, we got down to about 50 basis points. So if you bought a 10-year US Treasury, you would make 0.5% every single year for 10 years. And now, you can basically make 3.5%. I think we closed about 3.55 this afternoon, which is a much better deal. And if you're thinking about, someone who's in retirement, you've got 40% of your portfolio in fixed income, 3.5% is a great yield while taking zero risk because the US Treasuries are considered a risk-free asset. Munis, which are my bread and butter. I'm a muni trader by background. Typically, you'd hear me say munis are the best bonds to buy. That's not so much the case right now. Right now, we've seen issuance drop precipitously in muni bonds. We've seen spreads compress really over the last 3 months to a point where at this point, if you bought a 10-year AAA municipal bond, even if you're in the highest tax bracket, you're going to get about the same return as you get on a treasury. So even for taxable accounts right now, we're looking at options within the taxable bond space, because munis have been so bought up and there's so much demand for them, that they really aren't any more attractive than buying a treasury. And in fact, you may end up making less money on a bond that has a little bit more credit risk than you would in a traditional treasury. So where is the real value? The value right now, we believe, is in mortgage backs. Spreads on mortgage backs have blown out. Obviously, there's a number of reasons for that as well. Banks don't want to hold them. We saw Wells Fargo essentially exit the space. They were the biggest player in mortgage servicing in the banking industry, and they basically washed their hands and said, we're not doing this anymore. You have the Federal Reserve, which is actively selling them off their balance sheet because they bought them all through quantitative easing. And also the housing market slowed a little bit. And so we've got this basically triple whammy of, a AAA asset that nobody wants to hold. And so we've seen the values of those drop, which means that the yields are going up. And so we're in a position now where mortgage backs, despite all of the, the stigma and the headline risk, everyone thinks mortgage backs are toxic from 2008. They're actually a very clean asset, particularly now that there've been so many regulatory changes in lending, that we think this is a great spot to be in. So you can see here, mortgage rates, again, remain elevated. I think Mario asked in the Q1 macro presentation, how high do we think mortgage rates were going to get? And I said 6. I was off. It was actually 7. But we got there a lot faster than we ever thought we would see these kinds of rates. But that presents a tremendous opportunity. And in terms of their spread to treasuries, we are at all-time levels. I mean, even if you go all the way back to 2008, when nobody wanted to own mortgage-backed securities, we had the global financial crisis, you didn't see mortgage spreads this wide to the 30-year treasury. So in terms of credit quality, a 30-year mortgage bond is the same credit quality as a U.S. treasury. It's AAA. Ginnie Maes are explicitly backed by the U.S. government, but the difference is you can get over 6% on a 30-year treasury, where you're only getting about 3.5% on a 30-year. You get 6% on a 30-year mortgage bond versus about 3.5% on a 30-year treasury, which is a tremendous amount of wiggle room. And not only that, but a 30-year treasury, you're locked in for 30 years. That bond takes 30 years to mature. A mortgage bond is not that way. When you pay your mortgage, that first payment, you get principal back on that bond. And so that bond becomes less of a part of your portfolio over time. And it also shortens as people refinance, as people pay off their mortgages, it becomes less and less part of your portfolio and getting principal back every month. So you don't actually hold it for 30 years, just like most people don't have their mortgage for 30 years. So we think that's a great spot to be in. And really the barbelling of short-term treasuries and long-term municipal or mortgage-backed securities is going to be an excellent playbook, we think, for this year, particularly if the Fed scenario plays out where they're cutting by 100 basis points over the next 2 years. Holding a bond that's 6.5%, almost 7%, when they cut to 3 is going to be excellent, because you're going to get the premium going up on that bond, and you'll see outsized returns in mortgages. And so Ben's going to go through a little analysis we did on why we think mortgages could fall, and that would be beneficial for us.
Yeah, so what we did was we correlated mortgages with the 10-year interest rate and financial conditions, which is essentially just an index of how tight are lending standards, what is the overall financial conditions in the US. And what we found was that our model actually tracks the mortgage rate relatively closely. But if you drill down, you can see this gap up here in the last 6 months or so. And this is telling you that the mortgage rate in the market right now is about 100 basis points higher than what we would have modeled it with the same inputs. And this is for some of the reasons Tom expressed. Wells Fargo's trying to get out of the mortgage business. Federal Reserve's getting rid of some of the mortgage-backed securities. So you have a lot of these natural buyers exiting the market, and they need to be replaced by someone. So pension funds will probably update their investment policy statements. Endowment funds will probably do that to an extent, and that can help to close that spread back to zero, and would make mortgage rates a little bit more consistent with the 10-year treasury and the current financial conditions, which would be in about the 5.25% to 5.5% range. What's interesting here is you saw this in reverse in 2010. In 2010, when the Fed launched its quantitative easing program, started buying mortgage-backed securities, you actually saw mortgages trade tighter than what you would normally have imagined. Now we're seeing them trade wider, which creates more of an opportunity for what Tom suggested. Question that we often get is, well, what do current mortgage rates mean for home prices? This is the mortgage payment in real dollar terms going all the way back to the 1970s. And what you can see is that as rates rose, mortgage rates rose in the late 70s and early 80s, it became much, much more expensive to buy a house. And you're seeing that again today. Mortgage rates have risen, home prices are still high. One or both of those things need to correct. And so what some of the bears out there say is, well, the math's pretty simple. Home prices need to fall 30%. And that math is not wrong. At current rates, home prices to return to a long-term average mortgage payment would have to fall 32%. But there are a few confounding factors. Number one, that's going back to average. If you return to a normal bound, you're more in line. You also have mortgage rates that are probably a little bit too high right now. And now you're talking about maybe a 3% decline in home prices. You also have regional factors, maybe some home prices in Seattle or Austin we've heard a lot about, seeing significant home prices fall. But the other piece of that is we need more home supply. We need more home supply in that $250,000 to $300,000 range. Right now, the median home in the United States is $426,000. If we get more homes built in that $250,000 to $300,000 range, the median home price falls. And that's not because the value of your home or your home falls 30%. It's because that homes are more affordable. And so this is how we navigate that. I don't think that we're going to see a 30% decline in home prices. I hope we don't see that. But you know, there are definitely more off ramps than just a single home prices have to fall 30%. So I think that's something to remember as we talk about the housing market going forward. And again, if interest rates stabilize, if Fed policy stabilize, because I think that we see a bit of a normalization in mortgage rates anyway. And then if the Fed starts cutting rates, then we could see a little bit of a tailwind there as well. So portfolio management, I pulled this quote because I thought it fit with the aviation theme of the presentation. Having said that, we strive not to take the same risks as Chuck Yeager, who said, if you can walk away from a landing, it's a good landing. He also said, if you can fly the same plane the next day, then it's an excellent landing. So, yeah, so we're not trying to take those types of risks, but we are cognizant that they are out there in the market. We had this slide in the last presentation as well. There's one subtle change that we made. Last time on our assumptions, we said that risks appear weighted to the downside. Now they appear a little bit more balanced as we've discussed. The other piece that we really want to emphasize, and I think Tom did a good job about talking about this, is we want to emphasize assets with low to no reliance on financial markets. We want to avoid those businesses that are having to refinance bonds at higher and higher rates. We want to also emphasize businesses that have pricing power, but don't have to use pricing power. Companies that have just relied on raising prices for the last 2 or 3 years, that might not be sustainable. So if you sell rock and raise prices 8 to 12% every single year on rock, and inflation starts to come down, those 8 to 10, 12% price increases become a little bit less palatable. So those are things that we're considering in our investments. We did last quarter give you some investment ideas, some things that we were emphasizing at Narwhal. One was these HCA bonds. They get paid almost a 6% coupon. We liked the hospital space given some amelioration we were seeing in the labor markets. And they performed well. They were up 4.2%. We should have just given you the stock. That was up 26%. So we'll take it, but you know, we do own the stock. We do own the stock. We do own the stock. We were playing it a little bit cautious in the presentation. Costco was up 3.9%, which underperformed the Staples average because of a weak November. They had some issues with weather and some comparable periods. Eli Lilly, who had that drug called Mounjaro, which is indicated for diabetes. They're looking for it to get a weight loss indication. That performed well. That was up about 9% in line with the healthcare index. And Cisco took advantage of its backlog and was up 21%. This quarter, we're not going to give more ideas, but we are going to recap some companies and what they had to say at the ICR conference. So Tom and Jason are going to help me with this. Jason, why don't you kick it off with Krispy Kreme?
So I saw the Krispy Kreme management team speak at ICR. They're a relatively new management team, took over about 2 years ago and re-IPO'd the company about 1.5 years ago. So Krispy Kreme hadn't been really run like your traditional public company. They weren't seeking to maximize their value, making the best business decision every hand. They just want to sell some donuts. And so now they have a new CEO in there, and they already have a great brand. Everyone knows Krispy Kreme, and almost everyone has a positive opinion of Krispy Kreme. They cited a 97% favorable rating, which is as high as you'll see out there for any company. And the problem that they're facing is that Krispy Kremes can be tough to find. If you think of Dunkin' Donuts or Starbucks as their competitors, they're much easier to find, when you're driving around looking for, something in the morning. So what Krispy Kreme is doing is they're using a hub and spoke model to get their donuts from their existing stores with their retro look and get them in front of you on your Saturday morning. So they're going into grocery stores like Kroger, they're going to convenience shops, other places that you might be already, and basically leveraging up from their existing infrastructure to get in front of your face. And the reason that a McDonald's logo is there is because they are starting a new pilot test in Louisville in a few McDonald's where they're going to be selling Krispy Kreme in McDonald's. And so if that's successful, they'll be rolling that out to more stores. And I think that idea has a lot of potential for them.
Yeah, and Jason just hit on it. I think one of the big themes is when you think about the 4 P's of marketing, you got promotion, you got product, you have price, and you have place. Place is kind of the forgotten one. And for the last 2 years, people have been really focused on price. But what we saw at ICR is that management teams, especially astute management teams, are shifting a little bit more to how can I position my product from a placement standpoint, whether it's Krispy Kreme and McDonald's or other formats, in front of my consumers to meet my consumers where they are. And I think that was an interesting thing that kind of pervaded a lot of the presentations. Macy's Market is another example of that, or Market by Macy's. I am less confident in the success of this. They're rolling out Macy's small format stores in what they call strip centers because they're trying to get out of the mall, so they can't use mall in the name. But they're moving Market by Macy's into strip centers. They say that the net promoter scores are very good. Analysts love the idea. I'm a little bit less skeptical. I guess we'll see what happens with that. Tom and I were both in the Bolero presentation. So Tom, you want to talk a little bit about that?
I would say Jason was in there too, just to make sure he gets credit for that. So Bolero is super interesting. What they basically are is a bowling alley roll-up strategy. So their thesis is essentially that they're between 3,500 and 4,000 mom and pop owned bowling alleys around the country, and they're all janky. They kind of barely get by. They have no exit strategy, and so they're more sellers than buyers. And they can basically come in, totally revamp it. They've got some proprietary models in terms of getting you to get locked in on playing against yourself and potentially winning money on their app. They have unbelievable margins. They're growing like crazy. I'd say their biggest selling point is that their CEO is a handsome bald man named Tom, which I think we can all get behind. But we really enjoyed it. I think there was a lot to that presentation. I think they've got a lot of growth potential. So Bolero was a great one.
The CEO said that he wants it to be like going into the Wynn Casino. And he says that in many of his locations it is. So
he also said more people bowl each year than golf, which I think might actually be true.
He also said that more people watch bowling than MLS or I think the National Hockey League. So
It's a
they said a lot of things.
I believe in soccer.
I believe in soccer league too.
The Dutch Bros, which is that small format coffee shop, the interesting take here on Place was they're not necessarily positioned. They're thinking about where their consumers are, but what they're really thinking about is where their employees are. So they're building out 150 new stores this year, taking their store count up to 850. And what they're doing is they're identifying the locations of those stores based on where they can find employees, where they can find a good employee. So I thought that really stood out. Financing is also critical. Haverty's, which has no debt, said that they're looking at an opportunity to grow. A lot of these other businesses with their inventory financing situation or their loans are seeing higher costs. And Haverty's can operate from a position of strength and actually increase their store footprint. So they're planning to open 5 new stores this year. Typically they open 1 or 2. They've been around since the 1800s. Very conservatively managed company, local company. And so that's one that we're actually taking a tougher look at. Titan Machinery, dealer of a lot of agriculture, especially CNH products. Their big thing is move that inventory, because they want, if you move the inventory within a certain period of time, you don't have to pay financing costs for floor plan inventory. And so that's what they're trying to do. They're really trying to move that and make that machine work for them. Macy's did note that card balances are rising, and we talked a little bit about that. You know, your card balances are rising, delinquencies still remain low, but they are normalizing. Macy's was probably one of the more cautious companies as it talked about the retail landscape, which is somewhat understandable given the fact that they're a goods provider, not a services provider, and we're continuing to see that shift. And Tom, you want to talk a little bit about this 2024 maturity wall?
Yeah, so one of the big takeaways we took away was that, you know, private equity is essentially up against what they call the 2024 maturity wall. We kind of touched on it a little bit with the leveraged loans, which is that a lot of these private equity loans and private debt deals are all very short term, and the landscape has changed quite a bit. And so when it comes time to either pay off the debt or refinance it, we're going to see much higher interest rates. We're going to see much stricter covenants on that debt. And the question is, are a lot of these private equity companies going to be able to successfully navigate that maturity wall? And the answer is probably not. We're probably looking between 15 and 20% of these deals are going to be in very rough shape in the next 2 years. And so that's something we're keeping an eye on. It's just, you know, the lower levels of the fixed income market are going to start to get very rocky very soon. And that's, of course, at the end of that cycle is when we'll probably move away from high quality into lower credit quality pieces. You know, once we reset that credit, we see people get wiped off the chessboard, and we can move into some of the higher yielding stuff. But we think that's a shoe that is yet to drop.
One of the interesting takeaways from that too was that it might open the door for more strategic buyers. So versus all these financial buyers coming in and just making a financial transaction, levering up, it's a lot easier to do when interest rates are 0.5% than when interest rates are 4%. And when you're having to pay 11% on that debt. And so what you're seeing is more strategics being able to be competitive in some of those bidding wars, which could be very interesting for some M&A activity on the small scale over the next couple of years. So bringing it all together, where do we stand? Equities, valuations have normalized a lot. Again, earnings up 13%, the market actually down 19%. That's all normalization of equity valuations. Question is now, can earnings hold in there like they did in 2019? Fixed income, we are seeing some really good opportunities in clean credit. We're trying to stay away from dirty credit. We could see some more stabilization in the housing market if we can get more stabilization in inflation and more stabilization in monetary policy. Inflation does look like it's declining. We want to see that continue. And I think on the business side, it's really important for businesses to innovate, be able to move the needle with something other than pricing. You got to meet customers where they are and operate with lower levels of leverage if you can, because those high debt levels, high interest costs can really become a noose around your neck. Andrew, give us a Narwhal update.
Cool. Yeah. First and foremost, I don't think we own any Bolero stock.
No.
But my boss, Miss Natalie, is not here. And I'm thinking next macro is at Bolero.
Check. You got to make
sure.
sure.
We got to see. Maybe we buy a little bit of the stock before we go, and then we really juice those bar tabs. But Bolero, maybe we can make it happen. Ben famously was the cornhole cowboy at a charity event in which he took on all comers. And I'm thinking it might be time for the Bastion de Bolero to make an appearance. So Bolero next macro, don't hold me to it. We'll see if Natalie signs off on that. Great job by Ben, as always. Tom, Jason, all the investment committee, all the client service team. Thanks for all you do to get this event together. Appreciate you guys for coming. We will do Q&A in a moment. As a reminder, we started doing the Friday market memo on Friday, as it turns out. Every afternoon, it's around 3. Sometimes, we kind of forget about it till about 2:30, and then it's closer to 4 o'clock. But if you're not getting those emails, come see anybody from Narwhal. Give us your email address. We'll put you on that list. It's a great way to kind of get a high level view. That was actually an idea from a client who said, hey, it'd just be really helpful for me. I don't want to know every single thing you're doing, but I'd like to see at a high level, what are you guys looking at? What are you seeing? How are you reacting to the markets? We sent him one, and then we're like, wait, we should just send this to everybody. So if you're not getting that email, please let us know. Tom has done a lot of work on our fixed income side for years and years and years. People have asked, like, what's the point of bonds? Why does Tom even work there? They're so boring. There's no yield. And we're like, well, we just like Tom. He's a handsome bald guy named Tom, and everybody can get behind that. So for years, we've kind of been like, I don't really know. We just like hanging out with him. But no, now that's all a joke. Tom's excellent, obviously. But now bonds are a lot more interesting. The idea of going into mortgage backed specifically at a time in which everybody is moving away from them, the Fed included, is something that we don't really have the legwork to put into if there's not an opportunity there, or if we don't have the right people on our team. And so Tom is quick, he's aggressive, he's agile. He mentioned, pension funds potentially reevaluating their investment policy statement. Even if they said, hey, we want a lot more mortgage-backed security, we know how that business works. It's going to take forever. We're actually acting on these ideas now. And so we've really kind of upped our game on the comprehensive fixed income side. This has been really helpful for clients in a couple scenarios. One is individual cash management. People that say, hey, I've got, in my mind, you guys invest what you're investing, but I want to sit on X amount of money. We can roll treasury strategies that have money come and due every 15 days and get you a really attractive yield on that if it's money that you have no intention on touching. If it's money that you're saving for 3 weeks and then you're going to spend it, don't call us about that. But it's a really helpful tool. It's also been really helpful for a number of companies that we work with. And we're also starting to kind of dabble in our toes, put our toes into the water with companies like ourselves who just say, we don't understand bonds. And so we've really kind of ramped up our efforts to really take advantage of higher rates and the more nuanced aspects of the fixed income market. Jason Sieb passed his CFA level 1 exam last week. So congrats to Jason. He is speaking at a Hedge Week webinar. And then you can tell Ben made this presentation because Ben is speaking at the Harvard Club. He doesn't mention that Jason's speaking in his office, but he makes sure to emphasize that he's speaking at the Harvard Club. So Ben's speaking at a conference. We're continuing to get out there and try to talk about what we do and share it with as many people as possible. With that, we will open it up. John Boy, Q&A.
You got a couple questions. So the first one, Ben, this is probably directed to you, but do you see a scenario in the next 3 to 5 years where the dollar no longer is the international currency of trade?
It's just difficult to see because there a lot of commodities like oil are priced in dollar terms. That's what OPEC uses, for example.
And they hate us.
I think it's difficult to imagine. I don't know what would replace it. I don't think it would be the euro. I mean, the euro's depreciated 30% in the last couple of years, and even some of the other kind of emerging market currencies like the renminbi, it uses a band to price their currency relative to the US dollar. So I think it's the global reserve currency today. I think it will continue to be.
The next question, so I think this is in reference to the 1.7 earnings per unemployed person. So how can people afford not to work? Is it unemployment benefits, living off parents, something else?
I mean, that's a great question. I mean, a lot of it, the enhanced unemployment benefits that we had from that COVID period are gone. I mean, during the height of COVID, companies that we work closely with said, man, if you're a lower to mid-level employee, you can make more money not working than you can working here. And guess what? The work is work. It's hard. Why would you do this? And there was almost a tone of resignation of just like, I kind of get it. I wish they would work, but why work when you can not work and make more money? And so that aspect has certainly gone away. I think there is probably a wide cross section of people that are still over dependent on government stimulus, whether it's traditional unemployment or even disability, some of these things. So there's definitely a cross section of that. I think more likely this is something that, if not addressed, if we're sitting here in 5 years and we say, hey, the economy just kind of flatlined, we're exactly where we're right now, and it's still 1.7 to 1. The number one thing that I would be looking for is a massive increase in debt and credit delinquency. There are a lot of people across the economic spectrum living beyond their means. We see it all the time. You drive around and you look at how many, $80,000 cars are on the road. And you say, man, my car's old enough to drive. It's like, how many people actually have that kind of money where they're just rolling up to a dealership and taking on a $1,400 a month car payment over the course of 8 years. You see it all the time, but a lot of people, I would say probably the single number one cause is overextension.
You also have a big skills mismatch with, just because there are 1.7 jobs doesn't mean those 1.7 jobs actually want you. And or you even want those 1.7 jobs. If you were a hiring manager at Facebook, for example, and you were making hundreds of thousands of dollars a year, and your skill set is being a hiring manager in the Bay Area, that's a lot difficult to transport when you'd have to move. You'd have to probably move industries. And you may even have to get out of the industry altogether, and then you're probably not making the same amount of money that you were. And a lot of people don't want to sign up for that, so they'd rather stay on the other.
And I think part of that is probably the depleting of savings.
Yeah,
there are absolutely people who have been hired from this specific job making this amount of money and will not accept any of these jobs. And that's where you see that data feeds into the nationwide data on excess savings depletion.
Yeah, they'll take that job, but it's not a choice.
And the last question is just, what yield is the average blue chip corporate bond paying today?
So it kind of depends. It's kind of hard to say with blue chip. Like if you want to buy Apple, there's really no value there, right? You're going to get paid less than a treasury. Everyone is very comfortable with the credit quality of something like Apple. Once you get into kind of that triple B space, we've had a million of these macros. We've talked about how triple B bonds are horrible value.
If everything's triple B, nothing's
triple B. And that has changed quite a bit. Now you can basically go out and buy any 5-year JP Morgan, Morgan Stanley, Citigroup, doesn't matter what bank you pick, you can get 5.5% on a 5-year bond. Whether or not you should be buying those bonds from a credit perspective kind of is up in the air. But you can basically buy any triple B corporate bond, somewhere in that 5.5% range. I would argue you probably better served staying cleaner. Even still, if we are in a credit cycle, we start to see defaults, those are going to widen quite a bit, and you'll be underwater a little bit. I really like very short-term high yield bonds, stuff we talked about in the past, the Signet Finance or Dillard's or Cooper Tire, some of this single and double B stuff, where I think you get a lot more value. Those are paying upwards of 7%, and they mature in the beginning of 2024. That kind of stuff I really like. But the average corporate bond's paying a lot more now. Last year you buy a 5-year AT&T bond, you get paid 60 basis points. Now you're getting closer to 6%, which is ideal.
We have one more pop up.
Let's go.
Will the U.S. housing market crash or will continue to appreciate?
I don't think no.
Yeah.
I don't think there's an impending crash. There's still such a shortage of housing, whether you're renting or owning, due to a number of extenuating circumstances. I'm renting a house right now that is half the square footage. I knew we were going to get a housing market question, so I did the math on this, but I'm renting a house right now that's half the square footage of my home that I own, and my rental payment is 38% higher than my mortgage. Why am I doing that? Because I don't have a choice, and it's in the same school district. I don't have to register a change of address with the schools. My daughter can ride the same bus system, all of those things. And it's fine. It works. It's going to work. But that's really where we are right now. And that house went on the market January 1st, and we were calling them January 1st to rent it. And I think that's still a pretty common support for housing. I think at the most extreme, been laid out potentially a 30% decline in home prices. I'm more of the camp that could we see 10 to 15? That seems more likely to me. And I don't think Ben was calling for 30%, but I'm kind of in the camp of 10 to 15. Long term, I would expect appreciation there. I think it was JP Morgan for years had a data set where they talked about the 100+ year return of home values relative to inflation, and your long-term expectation nationwide was that home prices should surpass inflation by about 1% on an annual basis. There's two things you should learn from that. One, you're buying a primary residence as an investment. Forget about it. Like, that shouldn't be the reason you're doing it. You should buy a home because you can afford it, because it's in a good neighborhood, good square footage, nice setup, open concept kitchen, whatever you like. That's why you buy a house, not because, hey, I'm going to make so much money on this. So that's one part. But the other part is, it's not a new phenomenon that we're underbuilt. The only reason housing long-term should surpass the rate of inflation in terms of its cost is if there is more demand than there is supply. So that's not a new phenomenon. It's just been massively exaggerated over the last decade.
You should probably clarify that you had a pipe first.
Yeah, I'm
Not that part out.
Oh,
I think
yeah.
it might be confusing.
Yeah. Yeah.
If you didn't know, just saying.
My wife kicked me out. So
That's it.
cool. Any questions in here? Awesome. Thank you guys. Appreciate you for coming. And feel free to see us if you have other questions. Cancel the meeting.